Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's driving investment markets and what to look out for in the days and weeks ahead. So we've had another eventful week in investment markets. So if we go back to last week's video, you may recall we were talking about the possible Fed rate rise, we were talking about Apple's earnings, we were talking about Facebook's earnings, we were talking about Brexit. Now we've had some resolution in all of those things. Let's just start with the Fed. The Fed cut interest rates as the market had expected. We had a 93% expectation, a 93% chance the market was putting on a Fed rate cut this week, and it did occur. So the market was happy. Had the Fed not cut interest rates, then that could have pulled the rug from underneath the market. So the Fed cut rates, tech earnings were blockbusters. Apple's earnings beat expectations, as did Facebook. Now, as the adage goes, as goes Apple, so goes the stock market. The bumper results from Apple almost gave the market permission to break towards new highs. In fact, the S&P 500 did push to new all-time highs this week. In fact, it did push to new all-time highs before the Fed rate cut and before Apple's earnings were released. And now that's not unusual, in fact. We've seen that in the lead up to Fed rate decisions the last sort of 4 or 5 occasions. But now we've had that rate cut, markets are obviously happy. Now with Brexit, it's a little bit more muddled. We've still got a lot of confusion around Brexit. Of course, we haven't actually Brexited on the 31st of October as Boris Johnson had promised. We've now got a general election instead in December. Now, that had a slight impact on the pound. The pound has strengthened again up towards the $1.30 level. We haven't quite got there yet. The market is still trying to decide what a UK election means for the pound. In some instances, people are saying it could be positive, especially if Boris Johnson gets a majority in Parliament so he could get his deal through. If we get a scenario where the Brexit party might get involved and get a large slug of the vote, then we could get a scenario where we actually have a hard Brexit still, a no-deal Brexit. So that would be negative for the pound. But of course, who knows? We don't know really where the pound is going to go in the coming months. So anybody who places large bets on that could find themselves caught on the wrong side of an aggressive move. Of course, with the trade deal, that's the other thing we've had. We had phase 1 of the trade deal apparently agreed in the last few weeks, and that drove the markets higher. So it seems like we've had a positive earnings season. We've had the Fed rate cut. We had some good tech earnings. And of course, we had some sort of good news around Brexit, although there's been a delay. That seemed to be enough. Everything seems to be going right for taking an aggressive position in stock markets. And of course, markets have pushed to all-time highs. And anybody who's an 80-20 investor member will know I previously analysed what happens when stock markets hit all-time highs. So go and have a look at that piece of research. This sort of, just to give you a bit of a hint, once you get an all-time high, it's much more likely you're going to get another one. It's not guaranteed, but the odds start to increase. So after weathering a potential storm this week, we've got the S&P 500 up towards 3,040. We've got the FTSE 100 up around 7,250. We've got the VIX falling down below 13, which is very low by recent history, by recent standards. We've had the yield on the 10-year US Treasury start to pull back again to 1.71. It did actually rally and actually increase to about 1.8, but we've since had it pull back slightly. So with all this good news, does that mean that stock markets have been given permission around the world to break to new all-time highs? Now, we have to be careful. At an index level, things are looking quite good, but we have to look beneath the index level. What's going on with individual stocks? How many stocks actually break into new 52-week highs, for example? We're talking about breadth. What you need to see is lots of stocks joining in the rally and the market not just being led by 1 or 2 stocks in particular, because if it does, then that means that it's more susceptible to a pullback of some kind. Now, we may see that. As I make this video, there's been news that's just broken to suggest that China is putting a negative spin on the outlook for a trade deal, saying that Trump is actually a difficult person to work with. We kind of all knew that. But the market started to pull back because they're now starting to price in the likelihood that we might not have a trade deal. It's just a minor pullback at the moment. It means that bonds pick up a little bit in the last day and some of the defensives start to do well. But on the whole, it hasn't been enough to reverse some of the euphoria we've seen in the last few days ahead of the US Federal Reserve. Now, what comes after that? What does the market usually do after you see 3 rate cuts by the Federal Reserve? Now, what does 3 rate cuts in a row by the Federal Reserve mean for markets going forward? Well, it's generally positive. I'll go into more detail with 80/20 investor members this week, but it's generally been positive for stock markets. Going forward, we've got to keep an eye on breadth, keep an eye on the trade war headlines, but of course we also need to look at some of the currency markets. I'll come back to it in a future video, but the US dollar is important now. So is it all been good news? There've been some negatives apart from the trade war headlines. Some of the economic news that's come out again is pointing to a weakening global economy. Now, the fundamentals are not as good as what the market seems to suggest where it is at the moment in terms of stock prices, but at the moment, as long as the Fed's got everybody's back, the market doesn't really care about fundamentals. We'll see if that will last. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com. You can contact me via Twitter, Money to the Masses with the number 2, or via other social media, including Instagram. And don't forget to follow our YouTube channel. So click that subscribe button.